A simplified schematic diagram would portray the essence of this revolution in American banking. State banks, in the decentralized system before the Civil War, every bank must stand or fall on its bottom. It can pyramid notes and deposits on top of specie, but its room for such inflationary expansion is limited, because any bank's expansion will cause increased spending by its clients on the goods and services of other banks. Notes or checks on the expanding bank will go into the coffers of other banks, which will call on the expanding bank for redemption. This will put severe pressure on the expanding bank, which cannot redeem all of its liabilities as it is, and whose reserve ratio has declined, and so it will be forced to contract its loans and liabilities, or else go under. Figure 2 would depict the inverted pyramid of the national banking system. New York City banks pyramid notes and deposits on top of specie and greenbacks. Reserve City banks pyramid their notes and deposits on top of specie, greenbacks, and deposits at New York City. And country banks pyramid on top of both. This means that, for example, if New York City banks inflate and expand their notes and deposits, they will not be checked by other banks calling upon them for redemption. Instead, Reserve City banks will be able to expand their own loans and liabilities by pyramiding on top of their own increased deposits at New York City banks. In turn, the country banks will be able to inflate their credit by pyramiding on top of their increased deposits at both Reserve City and New York banks. The whole nation is able to inflate uniformly and relatively unchecked by pyramiding on top of a few New York City banks. The national banks were not compelled to keep part of their reserves as deposits in larger banks, but they tended to do so, in the long run, so that they could expand uniformly on top of the larger banks, and in the short run, because of the advantages of having a line of credit with a larger correspondent bank, as well as earning interest on demand deposits at that bank. Let us illustrate in another way how the national banking system pyramided by centralizing reserves. Consider the hypothetical balance sheet of the various banks. Suppose that the country banks begin with $1 million in vault cash as their reserves. With the national banking system in place, the country banks can now deposit 3/5 or $600,000 of their cash in Reserve City banks in return for interest-paying demand deposits at those banks. Total reserves for the two sets of banks have not changed, but now, because the country banks can use their reserve deposits in Reserve City banks, the same total reserves can now be used by the banks to expand far more of their credit. For now, $400,000 in cash supports the same total of notes and deposits that the country banks had previously backed by $1 million. And the Reserve City banks can now expand $2.4 million on top of the new $600,000 in cash, or rather, $1.8 million in addition to the $600,000 due the city banks. In short, country bank reserves have remained the same, but Reserve City bank reserves have increased by $600,000, and they can engage in 4-to-1 pyramiding of credit on top of that. But that's not all, for the Reserve City banks can deposit half of their reserves at the New York banks. When they do that, the balance sheets of the respective banks change. Since the Reserve City banks are allowed to keep half of their reserves in the Central Reserve City banks, the former can still pyramid at $2.4 million on top of their new $600,000 and yet deposit $300,000 in cash at the New York banks. The latter then can expand another 4-to-1 on top of the new cash of $300,000, or increase their total notes and deposits to $1.2 million. In short, not only did the national banking system allow pyramiding of the entire banking structure on top of a few large Wall Street banks, the very initiating of the system allowed a multiple expansion of all bank liabilities by centralizing a large part of the nation's cash reserves from the individual state banks into the hands of the larger and especially the New York banks. For the expansion of $1.2 million on top of the new $300,000 at New York banks served to expand the liabilities going to the smaller banks, which in turn could pyramid on top of their increased deposits. But even without that further expansion, $1 million, which we will assume originally supported $6 million in notes and deposits, will now support, in addition to that $6 million, $2.4 million issued by the Reserve City banks and $1.2 million by the New York banks, to say nothing of further expansion by the latter two sets of banks, which will allow country banks to pyramid more liabilities. In June 1874, the fundamental structure of the national banking system was changed when Congress, as part of an inflationist move after the Panic of 1873, eliminated all reserve requirements on notes, keeping them only on deposits. This released over $20 million of lawful money from bank reserves and allowed a further pyramiding of demand liabilities. In the long run, it severed the treatment of notes from deposits, with notes tied rigidly to bank holdings of government debt and demand deposits pyramiding on top of reserve ratios in specie and greenbacks. But this centralized inverse pyramiding of bank credit was not all, for, in a way modeled by the free banking system, every national bank's expansion of notes was tied intimately to its ownership of U.S. government bonds. Every bank could only issue notes if it deposited an equivalent of U.S. securities as collateral at the U.S. Treasury, so that national banks could only expand their notes to the extent that they purchased U.S. government bonds. This provision tied the national banking system intimately to the federal government, and more particularly to its expansion of public debt. The federal government had an assured, built-in market for its debt, and the more the banks purchased that debt, the more the banking system could inflate. Monetizing the public debt was not only inflationary per se, it provided the basis, when done by the larger city banks, of other banks pyramiding on top of their own monetary expansion. The tie-in and the pyramiding process were cemented by several other provisions. Every national bank was obliged to redeem the obligations of every other national bank at par. Thus, the severe market limitation on the circulation of inflated notes and deposits, depreciation as the distance from the bank increases, was abolished. And while the federal government could not exactly make the notes of a private bank legal tender, it conferred quasi-legal tender status on every national bank by agreeing to receive all its notes and deposits at par for dues and taxes. It is interesting and even heartening to discover that, despite these enormous advantages conferred by the federal government, national banknotes fell below par with greenbacks in the financial crisis of 1867, and a number of national banks failed the next year. Genuine redeemability, furthermore, was made very difficult under the national banking system. Laxity was ensured by the fact that national banks were required to redeem the notes and deposits of every other national bank at par, and yet it was made difficult for them to actually redeem those liabilities in specie. For one of the problems with the pre-Civil War state banking system is that interstate or even intrastate branches were illegal, thereby hobbling the clearing system for swiftly redeeming another bank's notes and deposits. One might think that a national banking system would at least eliminate this problem, but on the contrary, branch banking continued to be prohibited, and interstate branch banking is illegal to this day. A bank would only have to redeem its notes at its own counter in its home office. Furthermore, the redemption of notes was crippled by the fact that the federal government imposed a maximum limit of $3 million a month by which national banknotes could be contracted. Reserve requirements are now considered a sound and precise way to limit bank credit expansion, but the precision can work two ways. Just as government safety codes can decrease safety by setting a lower limit for safety measures and inducing private firms to reduce safety downward to that common level, so reserve requirements can and ordinarily do, serve as the lowest common denominators for bank reserve ratios. Free competition can and generally will result in banks voluntarily keeping higher reserve ratios, but a uniform legal requirement will tend to push all the banks down to that minimum ratio. And indeed, we can see this now in the universal propensity of all banks to be fully loaned up, that is, to expand as much as is legally possible up to the limits imposed by the legal reserve ratio. Reserve requirements of less than 100% are more an inflationary rather than a restrictive monetary device. The national banking system was intended to replace the state banks, but many state banks continued aloof and refused to join, despite the special privileges accorded to the national banks. The reserve and capital requirements were more onerous, and at that period national banks were prohibited from making loans on real estate. With the state banks refusing to come to heel voluntarily, Congress, in March 1865, completed the Civil War revolution of the banking system by placing a prohibitive 10% tax on all banknotes, which had the desired effect of virtually outlawing all note issues by the state banks. From 1865 on, the national banks had a legal monopoly on the issue of bank notes. At first, the state banks contracted and disappeared under the shock, and it looked as if the United States would only have national banks. The number of state banks fell from 1,466 in 1863 to 297 in 1866, and total notes and deposits in state banks fell from $733 million in 1863 to only $101 million in 1866. After several years, however, the state banks readily took their place as an expanding element in the banking system, albeit subordinated to the national banks. In order to survive, the state banks had to keep deposit accounts at national banks, from whom they could buy national bank notes in order to redeem their deposits. In short, the state banks now became the fourth layer of the national pyramid of money and credit, on top of the country and other banks, for the reserves of the state banks became, in addition to vault cash, demand deposits at national banks, which they could redeem in cash. The multi-layered structure of bank inflation under the national banking system was intensified. In this new structure, the state banks began to flourish. By 1873, the total number of state banks had increased to 1,330, and their total deposits were $789 million. The Cook-Chase connection with the new national banking system was simple. As Secretary of the Treasury, Chase wanted an assured market for the government bonds that were being used so heavily during the Civil War. And as the monopoly underwriter of U.S. government bonds for every year except one from 1862 to 1873, J. Cook was even more directly interested in an assured and expanding market for his bonds. What better method of obtaining such a market than creating an entirely new banking system, the expansion of which was directly tied to the bank's purchase of government bonds from J. Cook? The Cook brothers played a major role in driving the National Banking Act of 1863 through a reluctant Congress. The Democrats, devoted to hard money, opposed the legislation almost to a man. Only a majority of Republicans could be induced to agree on the bill. After John Sherman's decisive speech in the Senate for the measure, Henry Cook, now head of the Washington office of the House of Cook, wrote jubilantly to his brother, "It will be a great triumph, Jay, and one to which we have contributed more than any other living man." The bank had been repudiated by the House and was without a sponsor in the Senate, and was thus virtually dead and buried when I induced Sherman to take hold of it, and we went to work with the newspapers. Going to work with the newspapers meant something more than mere persuasion for the Cook brothers. As monopoly underwriter of government bonds, Cook was paying the newspapers large sums for advertising, and so, the Cooks thought, as it turned out correctly, that they could induce the newspapers to grant them an enormous amount of free space, in which to set forth the merits of the new national banking system. Such space meant not only publicity and articles, but even more important, the fervent editorial support of most of the nation's press. And so the press, implicitly bought for the occasion, kept up the drumfire of propaganda for the new national banking system. As Cook himself related, for 6 weeks or more nearly all the newspapers in the country were filled with our editorials, written by the Cook brothers, condemning the state bank system and explaining the great benefits to be derived from the national banking system now proposed. And every day the indefatigable Cooks put on the desk of every congressman the relevant editorials from newspapers in their respective districts. While many state bankers, especially the conservative old-line New York bankers, opposed the national banking system, J. Cook, once the system was in place, plunged in with a will. Not only did he sell the national banks their required bonds, he also set up new national banks which would have to buy his government securities. His agents formed national banks in the smaller towns of the South and West. Furthermore, he set up his own 2 large national banks, the First National Bank of Philadelphia and the First National Bank of Washington, D.C. But the national banking system was in great need of a mighty bank in New York City to serve as the base of the inflationary pyramid for a host of country and reserve city banks. Shortly after the inception of the system, 3 national banks had been organized in New York, but none of them was large or prestigious enough to serve as the key fulcrum of the new banking structure. J. Cook, however, was happy to oblige, and he quickly established the Fourth National Bank of New York, capitalized at a huge $5 million. After the war, J. Cook favored resumption of specie payments, but only if greenbacks could be replaced 1-to-1 by new national banknotes. In his unbounded enthusiasm for national banknotes and their dependence on the federal debt, Cook urged repeal of the $300 million legal limit on national banknote issue. In 1865, he published a pamphlet proclaiming that in less than 20 years national banknote circulation would total $1 billion. The title of the pamphlet Cook published is revealing. How Our National Debt May Be a National Blessing. The debt is public wealth, political union, protection of industry, secure basis for national currency. By 1866, it was clear that the national banking system had replaced the state as the center of the monetary system of the United States. Only a year earlier, in 1865, state banknotes had totaled $142.9 million. By 1866, they had collapsed to $20 million. On the other hand, national banknotes grew from a mere $31.2 million in 1864, their first year of existence, to $276 million in 1866. And while, as we have seen, the number of state banks in existence was falling drastically from 1,466 to 297, the number of national banks grew from 66 in 1863 to 1,634 3 years later. The United States ended the war with a depreciated, inconvertible greenback currency and a heavy burden of public debt. The first question on the monetary agenda was what to do about the greenbacks. A powerful group of industrialists calling for continuation of greenbacks, opposing resumption and, of course, any contraction of money to prepare for specie resumption, was headed by the Pennsylvania iron and steel manufacturers. The Pennsylvania ironmasters, who had been in the forefront of the organized protective tariff movement since its beginnings in 1820, were led here and instructed by their intellectual mentor, himself a Pennsylvania ironmaster, the elderly economist Henry C. Carey. Carey and his fellow iron manufacturers realized that during an inflation, since the foreign exchange market anticipates further inflation, domestic currency tends to depreciate faster than domestic prices are rising. A falling dollar and rising price of gold, they realized, make domestic prices cheaper and imported prices higher, and hence functions as a surrogate tariff. A cheap money, inflationist policy, then, could not only provide easy credit for manufacturing, It could also function as an extra tariff because of the depreciation of the dollar and the rise in the gold premium. Imbibers of the Kerry gospel of high tariffs and soft money were a host of attendees at the famous Kerry Vespers, evenings of discussion of economics and politics. Influential Kerry disciples included economist and Pennsylvania ironmaster Stephen Colwell, Eber Ward, president of the Iron and Steel Association, John A. Williams, Pennsylvania iron manufacturer, I. Smith Homans, Jr., editor of the Banker's Magazine, and the powerful Representative William D. Kelly of Pennsylvania, whose lifelong devotion to the interest of the ironmasters earned him the proud sobriquet of Old Pig Iron. The Kerry circle also dominated the American Industrial League and its successor, the Pennsylvania Industrial League, which spread the Kerry doctrines of protection and paper money. Influential allies in Congress, if not precisely Kerry followers, were the radical leader Representative Thaddeus Stevens, himself a Pennsylvania ironmaster, and Representative John A. Griswold, an ironmaster from New York. Also sympathetic to greenbacks were many manufacturers who desired cheap credit, gold speculators who were betting on higher gold prices, and railroads who, as heavy debtors to their bondholders, realized that inflation benefits debtors by cheapening the dollar, whereas it also tends to expropriate creditors by the same token. One of the influential Kerry disciples, for example, was the leading railroad promoter, the Pennsylvanian Thomas A. Scott, leading entrepreneur of the Pennsylvania and Texas and Pacific Railroads. One of the most flamboyant advocates of the greenback inflation in the post-war era was the Wall Street stock speculator Richard Shell. In 1874, Shell became a member of Congress, where he proposed an outrageous pre-Keynesian scheme in the spirit of Keynes' later dictum that so long as money is spent, it doesn't matter what the money is spent on, be it pyramid building or digging holes in the ground. Shell seriously urged the federal government to dig a canal from New York to San Francisco, financed wholly by the issue of greenbacks. Shell's enthusiasm was perhaps matched only by the notorious railroad speculator and economic adventurer George Francis Train, who called repeatedly for immense issues of greenbacks. "Give us greenbacks, we say," Train thundered in 1867, "and build cities, plant corn, open coal mines, control railways, launch ships, grow cotton, establish factories, open gold and silver mines, erect rolling mills. Carry my resolution, and there is sunshine in the sky." The Panic of 1873 was a severe blow to many overbuilt railroads, and it was the railroad men who led in calling for more greenbacks to stem the tide. Thomas Scott, Collis P. Huntington, leader of the Central Pacific Railroad, Russell Sage, and other railroad men joined in a call for greenbacks. So strong was their influence that the Louisville Courier-Journal, in April 1874, declared, "The strongest influence at work in Washington upon the currency proceeded from the railroads. The great inflationists, after all, are the great trunk railroads." The greenback problem after the Civil War was greatly complicated by the massive public debt that lay over the heads of the American people. A federal debt which had tallied only $64.7 million in 1860 amounted to a huge $2.32 billion in 1866. Many ex-Jacksonian Democrats, led by Senator George H. Pendleton of Ohio, began to agitate for further issue of greenbacks solely for the purpose of redeeming the principal of the federal debts contracted in greenbacks during the war. In a sense, then, hard money hostility to both inflation and the public debt were now at odds. In a sense, the Pendletonians were motivated by a sense of poetic justice, of paying inflated debts in inflated paper, but in doing so they lost sight of the broader hard money goal. This program confused the party struggles of the post-Civil War period, but ultimately it is safe to say that the Democrats had a far greater proportion of congressmen devoted to hard money and to resumption than did the Republicans. Thus, Secretary of the Treasury Hugh McCulloch's Loan Bill of March 1866 which provided for contraction of greenbacks in preparation for resumption of specie payments, was passed in a House of Representatives vote of 56 to 52 and a Democratic vote of 27 to 1. And in April 1874, the Inflation Bill, admittedly vetoed later by President Grant, which provided for expansion of greenbacks and of national banknotes, was passed in the House by a Republican vote of 105 to 64, while the Democrats voted against it by a narrow margin of 35 to 37. In the meantime, despite repeated resolutions for the resumption of specie payments in 1865 and 1869, the dominant Republican Party continued to do nothing for actual resumption. The Pendleton Plan was adopted by the Democrats in their 1868 platform, and the Republican victory in the presidential race that year was generally taken as a conclusive defeat for that idea. Finally, however, the Democratic sweep in the congressional elections of 1874 forced the Republicans into a semblance of unity on monetary matters, and in the lame duck congressional session led by Senator John Sherman, they came up with the Resumption Act of January 1865. Despite the fact that the Resumption Act ultimately resulted in specie resumption, it was not considered a hard money victory by contemporaries. Sherman had forged a compromise between hard and soft money forces. It is true that the U.S. government was supposed to buy gold with government bonds to prepare for resumption on January 1, 1879. But this resumption was 4 years off, and Congress had expressed intent to resume several times before. And in the meantime, the soft money men were appeased by the fact that the bill immediately eliminated the $300 million limit on national banknotes, in a provision known as free banking. The only hard money compensation was an 80% pro rata contraction of greenbacks to partially offset any new national bank notes. The bulk of the opposition to the Resumption Act was by hard money congressmen, who, in addition to pointing out its biased ambiguities, charged that the contracted greenbacks could be reissued instead of retired. Hard money forces throughout the country had an equally scornful view of the Resumption Act. In a few years, however, they rallied as resumption drew near. That the Republicans were generally less than enthusiastic about specie resumption was revealed by the Grant administration's reaction to the Supreme Court's decision in the first legal tender case. After the end of the war, the question of the constitutionality of legal tender came before the courts. We have seen that in the California and Oregon courts decided irredeemable paper to be unconstitutional. In the large number of state court decisions on greenbacks before 1870, every Republican judge but one upheld their constitutionality, whereas every Democratic judge but two declared them unconstitutional. The greenback question reached the U.S. Supreme Court in 1867 and was decided in February 1870 in the case of Hepburn v. Griswold. The court held by a vote of 5 to 3, with all the Democratic judges voting with the majority and the Republicans in the minority. Chief Justice Salmon P. Chase, who delivered the decision denouncing his own action as Treasury Secretary as unnecessary and unconstitutional, had swung back to the Democratic Party and had actually been a candidate for a presidential nomination in the 1868 convention. The Grant administration was upset by Hepburn v. Griswold, as were the railroads, who had accumulated a heavy long-term debt which would now be payable in more valuable gold. As luck would have it, however, there were 2 vacancies on the court, one of which was created by the retirement of one of the majority judges. Grant appointed not only 2 Republican judges, but 2 railroad lawyers whose views on the subject were already known. The new 5 to 4 majority dutifully and quickly reconsidered the question, and in May 1871 reversed the previous court in the fateful decision of Knox v. Lee. From then on, paper money would be held consonant with the U.S. Constitution. The national banking system was ensconced after the Civil War. The number of banks, national bank notes, and deposits all pyramided upward, and after 1870 state banks began to boom as deposit-creating institutions. With lower requirements and fewer restrictions than the national banks, they could pyramid on top of national banks. The number of national banks increased from 1,294 in 1865 to 1,968 in 1873, while the total number of state banks rose from 349 to 1,330 in the same period. Total state and national bank notes and deposits rose from $835 million in 1865 to $1.964 billion in 1873, an increase of 135.2%, or an increase of 16.9% per year. The following year, the supply of bank money leveled off as the Panic of 1873 struck and caused numerous bankruptcies. As a general overview of the national banking period, we can agree with Klein that the financial panics of 1873, 1884, 1893, and 1907 were in large part an outgrowth of reserve pyramiding and excessive deposit creation by reserve city and central reserve city banks. These panics were triggered by the currency drains that took place in periods of relative prosperity when banks were loaned up. And yet it must be pointed out that the total money supply, even merely the supply of bank money, did not decrease after the panic but merely leveled off. Orthodox economic historians have long complained about the Great Depression that is supposed to have struck the United States in the Panic of 1873 and lasted for an unprecedented 6 years in 1879. Much of this stagnation is supposed to have been caused by a monetary contraction, leading to the resumption of specie payments in 1879. Yet, what sort of depression is it which saw an extraordinarily large expansion of industry, of railroads, of physical output, of net national product, or real per capita income? As Friedman and Schwartz admit, the decade 1869 to 1879 saw a 3.0% per annum increase in money national product, an outstanding real national product growth of 6.8% per year in this period, and a phenomenal rise of 4.5% per year in real product per capita. Even the alleged monetary contraction never took place, the money supply increasing by 2.7% per year in this period. From 1873 to 1878, before another spurt of monetary expansion, the total supply of bank money rose from $1.964 billion to $2.221 billion, a rise of 13.1% or 2.6% per year. In short, a modest but definite rise and scarcely a contraction. It should be clear, then, that the Great Depression of the 1870s is merely a myth brought about by the misinterpretation of the fact that prices in general fell sharply during the entire period. Indeed, they fell from the end of the Civil War until 1879. Friedman and Schwartz estimated that prices in general fell from 1869 to 1879 by 3.8% per annum. Unfortunately, most historians and economists are conditioned to believe that steadily and sharply falling prices must result in depression. Hence their amazement at the obvious prosperity and economic growth during this era. For they have overlooked the fact that in the natural course of events, when government and the banking system do not increase the money supply very rapidly, free market capitalism will result in an increase in production and economic growth so great as to swamp the increase of money supply. Prices will fall, and the consequences will be not depression or stagnation, but prosperity, since costs are falling too, economic growth, and the spread of increased living standard to all the consumers. Indeed, recent research has discovered that the analogous Great Depression in England in this period was also a myth, and due to a confusion between a contraction of prices and its alleged inevitable effect on a depression of prices and its alleged inevitable effect on a depression of business activity. It might well be the major effect of the Panic of 1873 was not to initiate a Great Depression, but to cause bankruptcies in overinflated banks and in railroads riding on the tide of vast government subsidy and bank speculation. In particular, we may note J. Cook, one of the creators of the national banking system and paladin of the public debt. In 1866, he favored contraction of the greenbacks and early resumption because he feared that inflation would destroy the value of government bonds. By the late 1860s, however, the House of Cook was expanding everywhere, and in particular had gotten control of the new Northern Pacific Railroad. Northern Pacific had been the recipient of the biggest federal largesse to railroads during the 1860s, a land grant of no less than 47 million acres. Cook sold Northern Pacific bonds as he had learned to sell government securities, hiring pamphleteers to write propaganda about the alleged Mediterranean climate of the Northwest. Many leading government officials and politicians were on the Cook Northern Pacific payroll, including President Grant's private secretary, General Horace Porter. In 1869, Cook expressed his monetary philosophy in keeping with his enlarged sphere of activity. Why, he asked, should this grand and glorious country be stunted and dwarfed, its activities chilled and its very lifeblood curdled by these miserable hard-coin theories, the musty theories of a bygone age? These men who are urging on premature resumption know nothing of the great and growing West, which would grow twice as fast if it was not cramped for the means necessary to build railroads and improve farms and convey the produce to market. But in 1873, a remarkable example of poetic justice struck J. Cook. The overbuilt Northern Pacific was crumbling, and a Cook government bond operation provided a failure. So the mighty House of Cook, stunted and dwarfed by the market economy, crashed and went bankrupt, touching off the panic of 1873. After passing the Resumption Act in 1875, the Republicans finally stumbled their way into resumption in 1879, fully 14 years after the end of the Civil War. The money supply did not contract in the late 1870s because the Republicans did not have the will to contract in order to pave the way for resumption. Resumption was finally achieved after a substantial sales of U.S. bonds for gold in Europe by Secretary of the Treasury Sherman. Return to the gold standard in 1879 was almost blocked in the last 3 years before resumption by the emergence of a tremendous agitation, heavily in the West but also throughout the country, for the free coinage of silver. The United States mint ratios had been undervaluing silver since 1834, and in 1853 de facto gold monometallism was established because silver was so far undervalued as to drive fractional silver coins out of the country. Since 1853, the United States, while de jure on a bimetallic standard of 16-1, with the silver dollar still technically in circulation, though non-existent, was actually on a gold monometallic standard with lightweight subsidiary silver coins for fractional use. In 1872, it became apparent to a few knowledgeable men at the U.S. Treasury that silver, which had held at about 15.5-1 since the early 1860s, was about to suffer a huge decline in value. The major reason was the realization that European nations were shifting from a silver to a gold standard, thereby decreasing their demand for silver. A subsidiary reason was the discovery of silver mines in Nevada and other states in the West. Working rapidly, these Treasury men, along with Senator Sherman, slipped through Congress in February 1873 a seemingly innocuous bill which in effect discontinued the minting of any further silver coins. This was followed by an Act of June 1874 which completed the demonetization of silver by ending the legal tender quality of all silver coins above the sum of $5. The timing was perfect, since it was in 1874 that the market value of silver fell to greater than 16-1 to gold for the first time. From then on, the market price of silver fell steadily, declining to nearly 18-1 in 1876, over 18-1 in 1879, and reaching the phenomenal level of 32-1 in 1894. In short, after 1874, silver was no longer undervalued but overvalued, and increasingly so, in terms of gold at 16-1. Except for the acts of 1873 and 1874, labeled by pro-silver forces as the crime of 1873, silver would have flowed into the United States, and the country would have been once again on a de facto monometallic silver standard. The champions of greenbacks, the champions of inflation, saw a hard money way to increase greatly the amount of American currency, the remonetization of a flood of new overvalued silver. The agitation was to remonetize silver by the free and unlimited coinage of silver at 16 to 1. It should be recognized that the Silverites had a case. The demonetization of silver was a crime, in the sense that it was done shiftily, deceptively, by men who knew that they wanted to demonetize silver before it was too late and have silver replace gold. The case for gold over silver was a strong one, particularly in an era of rapidly falling value of silver, but it should have been made openly and honestly. The furtive method of demonetizing silver, the crime against silver, was in part responsible for the vehemence of the silver agitation for the remainder of the century. Ultimately, the administration was able to secure the resumption of payments in gold, but at the expense of submitting to the Bland-Allison Act of 1878, which mandated that the Treasury purchase $2 to $4 million of silver per month from then on. It should be noted that this first silver agitation of the late 1870s, at least, cannot be considered an agrarian or a particularly Southern and Western movement. The silver agitation was broad-based throughout the nation, except in New England, and was, moreover, an urban movement. As Weinstein points out, silver began as an urban movement, furthermore, not an agrarian crusade. Its original strongholds were the large towns and cities of the Midwest and Middle Atlantic states, not the country's farming communities. The first batch of bimetallist leaders were a loosely knit collection of hard-money newspaper editors, businessmen, academic reformers, bankers, and commercial groups. With the passage of the Silver Purchase Act of 1878, silver agitation died out in America, to spring out again in the 1890s. The Gold Standard Era with the National Banking System, 1879 to 1913. The record of 1879 to 1896 is very similar to the first stage of the alleged Great Depression from 1873 to 1879. Once again, we have a phenomenal expansion of American industry, production, and real output per head. Real reproducible, tangible wealth per capita rose at a decadal peak in American history in the 1880s at 3.8% per annum. Real net national product rose at the rate of 3.7% per year from 1879 to 1897, while per capita net national product increased by 1.5% per year. Once again, orthodox economic historians are bewildered, for there should have been a Great Depression, since prices fell at a rate of over 1% per year in this period. Just as in the previous period, the money supply grew, but not fast enough to overcome the great increase in productivity and the supply of products. The major difference in the two periods is that money supply rose more rapidly from 1879 to 1897 by 6% per year compared with the 2.7% per year in the earlier era. As a result, prices fell by less, by over 1% per annum as contrasted to 3.8%. Total bank money, notes, and deposits rose from $2.45 billion to $6.06 billion in this period, a rise of 10.45% per annum, surely enough to satisfy all but the most ardent inflationists. For those who persist in associating a gold standard with deflation, it should be pointed out that price deflation in the gold standard 1879 to 1897 period was considerably less than price deflation from 1873 to 1879, when the United States was still on a fiat greenback standard. After specie resumption occurred successfully in 1879, the gold premium to greenbacks fell to par, and the appreciated greenback promoted confidence in the gold-backed dollar. More foreigners willing to hold dollars meant an inflow of gold into the United States and greater American exports. Some historians have attributed the boom of 1879 to 1882, culminating in a financial crisis in the latter year, to the inflow of gold coin in the U.S., which rose from $110.5 million in 1879 to $358.3 million in 1882. In a sense, this is true, but the boom would never have taken on considerable proportions without the pyramiding of the national banking system, the deposits of which increased from $2.149 billion in 1879 to $2.777 billion in 1882, a rise of 29.2%, or 9.7% per annum. Wholesale prices were driven up from 90 in 1879 to 108 3 years later, a 22% increase before resuming their long-run downward path. A financial panic in 1884, coming during a mild contraction after 1882, lowered the supply of bank money in 1884. Total bank notes and deposits dropped slightly from $3.19 billion in 1883 to $3.15 billion the following year. The panic was triggered by an overflow of gold abroad as foreigners began to lose confidence in the willingness of the United States to remain on the gold standard. This understandable loss of confidence resulted from the inflationary sop to the pro-silver forces in the Bland-Allison Silver Purchase Act of 1878. The shift in Treasury balances from gold to silver struck a disquieting note in foreign financial circles. Before examining the critical decade of the 1890s, it is well to point out in some detail the excellent record of the first decade after the return to gold, 1879 to 1889. America went off the gold standard in 1881 and remained off after the war's end. Arguments between hard money advocates who wanted to eliminate unbacked greenbacks and soft money men who wanted to increase them raged through the 1870s until the Grant administration decided in 1875 to resume redemption of paper dollars into gold at pre-war value on the first day of 1879. At the time, 1875, greenbacks were trading at a discount of roughly 17% against the pre-war gold dollar. The combination of outright paper money deflation and increase in official gold holdings enabled a return to gold 4 years later, which set the scene for a decade of tremendous economic growth. Economic record-keeping a century ago was not nearly as well developed as today, but a clear picture comes through nonetheless. The Encyclopedia of American Economic History calls the period under review one of the most expansive in American history. Capital investment was high, there was little unemployment, and the real cost of production declined rapidly. Prices, wages, and real wages. This is shown most graphically with a look at wages and prices during the decade before and after convertibility. While prices fell during the 1870s and 1880s, wages fell only during the Greenback period and rose from 1879 to 1889. Both consumer prices and nominal wages fell about 30% during the last decade of greenbacks. But from 1879 to 1889, while prices kept falling, wages rose 23%. So real wages, after taking inflation, or the lack of it, into effect, soared. No decade before or since produced such a sustainable rise in real wages. Two possible exceptions are the period from 1909 to 1919, when the index rose from 99 to 140, and 1929 to 1939, 134 to 194. But during the first decade, real wages plummeted the next year to 129 in 1920, and did not reach 1919's levels until 1934. And during the 1930s, real wages also soared, for those fortunate enough to have jobs. In any event, the contrast to this past decade is astonishing, and while there are many reasons why real wages increase, three necessary conditions must be present. Foremost, an absence of sustained inflation. This contributes to the second condition, a rise in savings and capital formation. People will not save if they believe their money will be worth less in the future. Finally, technological advancement is obviously important, but it is not enough. The 1970s saw this third factor present, but the absence of the first two caused real wages to fall. Interest rates. Sidney Homer writes in his monumental History of Interest Rates, 2000 B.C. to the present, during the last 2 decades of the 19th century, 1880 to 1900, long-term bond yields in the United States declined almost steadily. The nation entered its first period of low long-term interest rates, finally experiencing the 3 to 3.5 long-term rates which had characterized Holland in the 17th century and Britain in the 18th and 19th. In short, the economic giants of their day. To gauge long-term rates of the day, it is best to use the long-term government bonds we would use today as a measure. The National Banking Acts of 1863 to 1864 stipulated that these bonds had to be used to secure banknotes. This created such a demand for them that, as Homer says, by the mid-1870s it put governmental bond pricing up to levels where their yields were far below acceptable rates of long-term interest. But the Commerce Department tracks the unadjusted index of yields of American railroad bonds. We list the yields for 1878, the year before gold, 1879, and 1889. 1878, 6.45%. 1879, 5.98%, 1889, 4.43%. We stress that with consumer prices at about 7% lower in 1889 than they had been a decade before, the real rate of return by decade's end was well into double-digit range, a bonanza for savers and lenders. Short-term interest rates during the last century were considerably more skittish than long-term rates. But even here, the decennial averages of annual averages of both 3 to 6 month commercial paper rates and overnight call money during the 1880s declined from what it had been the previous decades. 1870 to 1879, commercial paper was 6.46%, call money 5.73%. 1880 to 1889, commercial paper 5.14%, call money 3.98%. A burst in productivity. By some measures, the 1880s was the most productive decade in our history. In their A Monetary History of the United States, 1867 to 1960, Professors Friedman and Schwartz quote R.W. Goldsmith on the subject. The highest decadal rate of growth of real reproducible tangible wealth per head from 1805 to 1950 for periods of about 10 years was apparently reached in the 80s with approximately 3.8%. The statistics give proof to this outpouring of new wealth. Gross domestic product almost doubled from the decade before, a far larger percentage jump decade on decade than any time since. The 26.5% increase ranks among the best in our history. Labor productivity reflects increased capital investment. Capital formation. From 1869 to 1879, the total number of business establishments barely rose, but the next decade saw a 39.4% increase. Not surprisingly, a decade of falling prices, rising real income, and lucrative interest returns made for tremendous capital investment, ensuring future gains in productivity. The massive 5% decade-on-decade increase has never since even been closely rivaled. It stands in particular contrast to the virtual stagnation witnessed by the 1970s. 5-year averages are not clean as some figures, but still show a rough doubling of total capital formation from the 70s to the 80s. It has repeatedly been alleged that the late 19th century, the golden age of the gold standard in the United States, was a period especially harmful to farmers. The facts, however, tell a different story. While manufacturing in the 1880s grew more rapidly than did agriculture, the census of 1890, report Friedman and Schultz, was the first in which the net value added by manufacturing exceeded the value of agricultural output. farmers had an excellent decade. So farms, farmland, productivity, and production all increased in the 1880s, even while commodity prices were falling. And, as we see below, farm wage rates, even in nominal terms, rose during this time. This phenomenal economic growth during the decade immediately after the return to gold convertibility cannot be attributed solely to the gold standard. Indeed, all during this time there was never a completely free market monetary system. The National Banking Acts of 1863, 1864 had semi-cartelized the banking system. Only certain banks could issue money, but all other banks had to have accounts at these. The financial panics throughout the late 19th century were a result of the arbitrary credit creation powers of the banking system. While not as harmful as today's inflation mechanism, it was still a storm in an otherwise fairly healthy economic climate. The fateful decade of the 1890s saw the return of the agitation for free silver, which had lain dormant for a decade. The Republican Party intensified its longtime flirtation with inflation by passing the Sherman Silver Purchase Act of 1890, which roughly doubled the Treasury purchase requirement of silver. The Treasury was not mandated to buy 4.5 million ounces of silver per month. Furthermore, payment was to be made in a new issue of redeemable greenback currency, Treasury notes of 1890, which were to be full legal tender, redeemable in either gold or silver at the discretion of the Treasury. Not only was this an increased commitment to silver, it was a significant step on the road to bimetallism, which, at the depreciated market rates, would mean inflationary silver monometallism. In the same year, the Republicans passed the High McKinley Tariff Act of 1890, which reaffirmed their commitment to high tariffs and soft money. Another unsettling inflationary move made in the same year was that the New York Sub-Treasury altered its long-standing practice of settling its clearinghouse balances in gold coin. Instead, in August 1890, it began using the old greenbacks and the new Treasury notes of 1890. As a result, these paper currencies largely replaced gold paid in customs receipts in New York. Uneasiness about the shift from gold to silver and the continuing free silver agitation caused foreigners to lose further confidence in the U.S. gold standard and to cause a drop in capital imports and severe gold outflows from the country. This loss of confidence exerted contractionist pressure on the American economy and reduced potential economic growth during the early 1890s. Fears about the American gold standard were intensified in March 1891, when the Treasury suddenly imposed a stiff fee on the export of gold bars taken from its vaults, so that most gold exported from then on was American gold coin rather than bars. A shock went through the financial community in the U.S. and abroad when the United States Senate passed a silver-free coinage bill in July 1892. The fact that the bill went no further was not enough to restore confidence in the gold standard. Banks began to insert clauses in loans and mortgages requiring payment in gold coin. Clearly, the dollar was no longer trusted. Gold exports intensified in 1892, the Treasury's gold reserve declined, and a run ensued on the U.S. Treasury. In February 1893, the Treasury persuaded New York banks, which had drawn down $6 million on gold from the Treasury by presenting Treasury notes for redemption, to return the gold and reacquire the paper. This act of desperation was scarcely calculated to restore confidence in the paper dollar. The Treasury was paying the price for specie resumption without bothering to contract the paper notes in circulation. The gold standard was therefore inherently shaky, resting only on public confidence, and that was giving way under the silver agitation and under desperate acts by the Treasury. Poor Grover Cleveland, a hard-moneyed Democrat, assumed the presidency in the middle of this monetary crisis. 2 months later, the stock market collapsed, and a month afterwards, in June 1893, distrust of the fractional reserve banks led to a massive bank run and bank failures throughout the country. Once again, however, many banks, national and state, especially in the West and South, were allowed to suspend specie payments. The panic of 1893 was on. In a few months, Eastern bank suspension occurred beginning with New York City. The total money supply, gold coin, treasury paper, national bank notes, and national and state bank deposits fell by 6.3% in 1 year, from June 1892 to June 1893. Suspension of specie payments resulted in deposits, which were no longer immediately redeemable in cash, going to a discount in relation to currency during the month of August. As a result, deposits became less useful, and the public tried its best to intensify its exchange of deposits for currency. By the end of 1893, the panic was over, as foreign confidence rose with the Cleveland administration's successful repeal of the Sherman Silver Purchase Act in November of that year. Further silver agitation of 1895 endangered the Treasury's gold reserve, but heroic acts of the Treasury, including buying gold from a syndicate of bankers headed by J.P. Morgan and August Belmont, restored confidence in the continuance of the gold standard. The victory of the free silver Bryanite forces at the 1896 Democratic Convention caused further problems for gold, but the victory of the pro-gold Republicans put an end to the problem of domestic and foreign confidence in the gold standard. 1896. The transformation of the American party system. Orthodox economic historians attribute the triumph of William Jennings Bryan in the Democratic Convention of 1896 and his later renominations for president as a righteous rising up of the people demanding inflation over the interests holding out for gold. Friedman and Schwartz attribute the rise of Bryanism to the price contraction of the last 3 decades of the 19th century, and the triumph of gold and the disappearance of the money issue to the price rise after 1896. This conventional analysis overlooks several problems. First, if Bryan represented the people versus the interests, why did Bryan lose, and lose soundly, not once, but 3 times? Why did gold triumph long before any price inflation became obvious? In fact, at the depths of price contraction in 1896. But the main neglect of the conventional analysis is the disregard for the highly illuminating insights provided in the past 15 years by the new political history of 19th century American politics and its political culture. The new political history began by going beyond national political issues, largely economic, and investigating state and local political contests. It also dug into the actual voting records of individual parishes, wards, and counties, and discovered how people voted and why they voted the way they did. The work of the new political history is truly interdisciplinary, for its methods range from sophisticated techniques for voting analysis to illuminating insights into American ethnic religious history. In the following pages, we shall present a summary of the findings of the new political history on the American party structure of the late 19th century and after, and on the transformation of 1896 in particular. First, the history of American political parties is one of successive party systems. Each party system lasts several decades, with each particular party having a certain central character. In many cases, the name of the party can remain the same, but its essential character can drastically change. In the so-called critical elections. In the 19th century, the second party system, Whigs v. Democrats, lasted from about 1832 to 1854, was succeeded by the third party system, Republicans v. Democrats, lasting from 1854 to 1896. Characteristic of both party systems was that each party was committed to a distinctive ideology clashing with the other, and these conflicting worldviews made for fierce and close contests. Elections were particularly hard fought. Interest was high, since the parties offered a choice, not an echo, and so the turnout rate was remarkably high, often reaching 80 to 90% of eligible voters. More remarkably, candidates did not, as we are used to in the 20th century, fuzz their ideology during campaigns in order to appeal to a floating, ideologically indifferent, independent voter. There were very few independent voters. The way to win elections, therefore, was to bring out your vote, and the way to do that was to intensify and strengthen your ideology during campaigns. Any fuzzing over would lead Republican or Democratic constituents to stay home in disgust, and the election would be lost. Very rarely would there be a crossover to the other hated party. One problem that strikes anyone interested in 19th century political history is, how come the average person exhibited such great and intense interest in such arcane economic topics as banking, gold and silver, and tariffs? Thousands of half-literate people wrote embattled tracts on these topics, and voters were intensely interested. Attributing the answer to inflation or depression to seemingly evident economic interests, as do Marxists and other economic determinists, simply won't do. The far greater depressions and inflations of the 20th century have not educed nearly as much mass interest in economics as did the milder economic crises of the past century. Only the findings of the new political historians have cleared up this puzzle. It turns out that the mass of the public was not necessarily interested in what the elites or national politicians were talking about. The most intense and direct interest of the voters was applied to local and state issues, and on these local levels the two parties waged an intense and furious political struggle that lasted from the 1830s to the 1890s. The beginning of this century-long struggle began with the profound transformation of American Protestantism in the 1830s. This transformation swept like wildfire across the northern states, particularly Yankee territory, during the 1830s, leaving the South virtually untouched. The transformation found particular root among Yankee cultures with its aggressive and domineering spirit. This new Protestantism, called Pietist, was born in the fires of Charles Finney and the great revival movement of the 1830s. Its credo was roughly as follows: each individual is responsible for his own salvation, and it must come in an emotional moment of being born again. Each person can achieve salvation. Each person must do his best to save everyone else. This compulsion to save others was more than simple missionary work. It meant that one would go to hell unless he did his best to save others. But since each person is alone and facing the temptation to sin, this role can only be done by the use of the state. The role of the state is to stamp out sin and create a new Jerusalem on earth. The Pietists defined sin very broadly. In particular, the most important politically was demon rum, which clouded men's minds and therefore robbed them of their theological free will. In the 1830s, the evangelical Pietists launched a determined and indefatigable prohibitionist crusade on the state and local level which lasted a century. Second was any activity on Sunday except going to church, which led to a drive for a Sabbatarian blue law. Drinking on Sunday was, of course, a double sin, and hence particularly heinous. Another vital thrust of the new Yankee Pietism was to try to extirpate Roman Catholicism, which robs communicants of their theological free will by subjecting them to the dictates of priests who are agents of the Vatican. If Roman Catholics could not be prohibited per se, their immigration could be slowed down or stopped. And since their adults were irrevocably steeped in sin, it became vital for crusading Pietists to try to establish public schools as compulsory forces for Protestantizing society, or, as the Pietists like to put it, to Christianize the Catholics. If the adults are hopeless, the children must be saved by the public school and compulsory attendance laws. Such was the political program of Yankee Pietism. Not all immigrants were scorned. British, Norwegian, or other immigrants who belonged to Pietist churches, whether nominally Calvinist or Lutheran or not, were welcomed as true Americans. The Northern Pietists found their home almost to a man first in the Whig party and then in the Republican party, and they did so, too, among the Greenback and Populist parties, as we shall see further below. There came to this country during the century an increasing number of Catholic and Lutheran immigrants, especially from Ireland and Germany. The Catholics and High Lutherans, who have been called ritualists or liturgicals, had a very different kind of religious culture. Each person is not responsible for his own salvation directly. If he is to be saved, he joins the church and obeys its liturgy and sacraments. In a profound sense, then, the church is responsible for one's salvation, and there is no need for the state to stamp out temptation. These churches, then, especially the Lutheran, had a laissez-faire attitude toward the state and morality. Furthermore, their definitions of sin were not nearly as broad as the Pietists. Liquor is fine in moderation. Drinking beer with the family in beer parlors on Sunday after church was a cherished German, Catholic and Lutheran, tradition, and parochial schools were vital in transmitting religious values to their children in a country where they were in a minority. Virtually to a man, Catholics and High Lutherans found their home during the 19th century in the Democratic Party. It is no wonder that the Republicans gloried in calling themselves throughout this period the party of great moral ideas, while the Democrats declared themselves to be the party of personal liberty. For nearly a century, the bemused liturgical Democrats fought a defensive struggle against people whom they considered pietist fanatics, constantly swooping down, trying to outlaw their liquor, their Sunday beer parlors, and their parochial schools. How did all this relate to the economic issues of the day? Simply that the leaders of each party went to their voting constituents and raised their consciousness to get them vitally interested in national economic questions. Thus, the Republican leaders would go to their rank and file and say, just as we need big paternalistic government on the local and state level to stamp out sin and compel morality, so we need big government on the national level to increase everyone's purchasing power through inflation, keeping out cheap foreign goods, tariffs, or keeping out cheap foreign labor, immigration restrictions. And for their part, the Democratic leaders would go to their constituents and say, just as the Republican fanatics are trying to take away your liquor, your beer parlors, and your parochial schools, so the same people are trying to keep out cheap foreign goods, tariffs, and trying to destroy the value of your savings through inflation. Paternalistic government on the federal level is just as evil as it is at home. So statism and liberalism were expanded to other issues and other levels. Each side infused its economic issues with a moral fervor and passion stemming from their deeply held religious values. The mystery of the passionate interest of Americans in economic issues in this epoch is solved. Both in the second party and third party system, however, the Whigs and then the Republicans had a grave problem, partly because of demographics, greater immigration, and higher birth rates. The Democratic liturgicals were slowly but surely becoming the majority party in the country. The Democrats were split asunder by the slavery question in the 1840s and 50s. But now, by 1890, the Republicans saw the handwriting on the wall. The Democratic victory in the congressional races in 1890, followed by the unprecedented landslide victory of Grover Cleveland carrying both houses of Congress in 1892, indicated to the Republicans that they were becoming doomed to be a permanent minority. To remedy the problem, the Republicans in the early 1890s, led by Ohio Republicans William McKinley and Mark Hanna, launched a shrewd campaign of Reconstruction. In particular, in state after state, they ditched the prohibitionists, who were becoming an embarrassment and losing the Republicans large numbers of German Lutheran votes. Also, they modified their hostility to immigration. By the mid-1890s, the Republicans have moved rapidly toward the center, toward fuzzing over their political pietism. In the meanwhile, an upheaval was beginning to occur in the Democratic Party. The South, by now a one-party Democratic region, was having its own pietism transformed by the 1890s. Quiet pietists were now becoming evangelical, and Southern Protestant organizations began to call for prohibition. Then the new, sparsely settled mountain states, many of them with silver mines, were also largely pietist. Moreover, the power vacuum, which would ordinarily have been temporary, had been created in the National Democratic Party. Poor Grover Cleveland, a hard-money, laissez-faire Democrat, was blamed for the Panic of 1893, and many leading Cleveland Democrats lost their gubernatorial and senatorial posts in the 1894 elections. The Cleveland Democrats were temporarily weak, and the Southern Mountain Coalition was ready at hand. Seizing his opportunity, William Jennings Bryan and his Pietist coalition seized control of the Democratic Party at the momentous convention of 1896. The Democratic Party was never to be the same again. The Catholics, Lutherans, and the laissez-faire Cleveland Democrats were in mortal shock. The party of our fathers was lost. The Republicans, who had been moderating their stance anyway, saw the opportunity of a lifetime. At the Republican convention, Representative Henry Cabot Lodge, representing the Morgans and the pro-gold standard Boston financial interests, told McKinley and Hanna, "Pledge yourself to the gold standard, the basic Cleveland economic issue, and drop your Silverite and Greenback tendencies, and we will all back you. Refuse, and we will support Bryan or a third party." McKinley struck the deal, and from then on, the Republicans, in 19th century terms, were a centrist party. Their principles were now high tariffs and the gold standard, and prohibition was quietly forgotten. What would the poor liturgicals do? Many of them stayed home in droves, and indeed the election of 1896 marks the beginning of the great slide downward in voter turnout rates that continues to the present day. Some of them, in anguish at the Pietists, inflationist, and prohibitionist Bryanites, actually conquered their anguish and voted Republican for the first time in their lives. The Republicans, after all, had dropped the hated prohibitionists and adopted gold. The election of 1896 inaugurated the fourth-party system in America. From a third-party system of closely fought, seesawing races between a pietist, statist Republican versus a liturgical, libertarian Democratic Party, the fourth-party system consisted of a majority centrist Republican Party as against a minority pietist Democratic Party. After a few years, the Democrats lost their pietist nature, and they too became a centrist, though usually minority party, with a moderately statist ideology scarcely distinguishable from the Republicans. So the fourth-party system went until 1932. A charming anecdote told us by Richard Jensen sums up much of the 1896 election. The heavily German city of Milwaukee had been mainly Democratic for years. The German Lutherans and Catholics in America were devoted, in particular, to the gold standard and were bitter enemies of inflation. The Democratic nomination for Congress in Milwaukee had been obtained by a populist Democrat, Richard Schilling. Sounding for all the world like modern monetarists or Keynesians, Schilling tried to explain to the assembled Germans of Milwaukee in a campaign speech that it didn't really matter what commodity was chosen as money, that gold, silver, copper, paper, sauerkraut, or sausages would do equally well as money. At that point, the German masses of Milwaukee laughed Schilling off the stage, and the shrewdly opportunistic Republicans adopted as their campaign slogan, "Schilling and sauerkraut," and swept Milwaukee. The Greenbackers and later the pro-silver, inflationist, Bryanite populist party were not agrarian parties. They were collections of pietists aimed to stamp out personal and political sin. Thus, as Kleppner points out, the Greenback Party was less an amalgamation of economic pressure groups than an ad hoc coalition of true believers, ideologues, who launched their party as a quasi-religious movement that bore the indelible hallmark of a transfiguring faith. The Greenbackers perceived their movement as the religion of the Master in motion among men, and the Populists described their 1890 free silver contest in Kansas not as a political campaign, but as a religious revival, a crusade, a Pentecost of politics, in which a tongue of flame sat upon every man, and each spake as the Spirit gave him utterance. The people had heard the word and could not preach the gospel of populism. It was no accident, we see now, that the Greenbackers almost invariably endorsed prohibition, compulsory public schooling, and crushing of parochial schools, or that populists in many states declared unequivocally for prohibition or entered various forms of fusion with the Prohibition Party. The transformation of 1896 and the death of the third-party system meant the end of America's great laissez-faire, hard-money libertarian party. The Democratic Party was no longer the party of Jefferson, Jackson, and Cleveland. With no further political embodiment for laissez-faire in existence, and with both parties offering an echo, not a choice, public interest in politics steadily declined. A power vacuum was left in American politics for the new corporate statist ideology of progressivism, which swept both parties and created a short-lived Progressive Party in America after 1900. The Progressive era of 1900 to 1918 fastened a welfare-warfare state on America, which has set the mold for the rest of the 20th century. Statism arrived after 1900 not because of inflation or deflation, but because a unique set of conditions had destroyed the Democrats as a laissez-faire party and left a power vacuum for the triumph of the new ideology of compulsory cartelization through a partnership of big government, business, unions, technocrats, and intellectuals.